in 2017, believe it or not, I had a heart attack, and my family is surviving financially because of these rental properties that we own. That was when it really hit me, this is a life-changing thing. This really does work, and you really can survive on it. That's when I really all right, I'm all in on this stuff.
Like myself, I bought my first property in 2016 and then rented it out and started to see tenants paying my mortgage. I'm getting more extra money each month, paying down my bills. I'm able to pocket the rest. Right? And it becomes that inflection point where you're like, this is really something I should double down on.
Hello, and welcome back to another episode of Peak Profits. Today's guest is Ashley Garner, a 30-year veteran of the real estate world and founder of ABG & Associates. Ashley has acquired and operated over 300 multifamily units, combining hands-on operations with smart underwriting to deliver consistent cash flow for his investors. He's here to share how he transitioned from a licensed broker into a full-time syndicator, and how passive investors can partner with experienced operators like him to start building their own mailbox money mindset. Ashley, welcome to the podcast. It's a pleasure to have you on.
Yeah, thank you, Chris. Brian, thank you too. I'm happy to be here.
It would be great, Ashley, if you could take us all the way back to where it started, how your career evolved from being a broker in the 90s to running syndications across multiple states today.
Yeah, well, I can do that quickly. I grew up in this business, like the literal mom and pop hands-on version. My dad was a banker, but when I was like junior high school, he started buying old houses near the campus of West Virginia University, and we internally subdivided them into student rentals. We still actually own several of those still, after that's been a long time now. And so I grew up, with a hammer in my hand and fixing these old houses. Then it progressed to the leasing and management, financing, and all those good things. And so I kind of had that background a little bit, but again, it was very, do everything yourself, from the plumbing all the way to the financing, and which is a great experience. Then when I kind of went out into the world on my own, I guess, I just had real estate in my blood. So I got my broker's license and did that aspect of it for a while also. And there are lots of twists and turns, but they all have real estate at their heart. So I've done construction and development and had a hand in all these different kind of things. Worked for an appraiser in college, drawing floor plans. So it's definitely in my blood. The real estate brokerage, like residential brokerage side of it, to me was a wonderful day job, fabulous career. I loved every minute of it. But in the end, it's still a job, just like if I had worked at the post office or at the bank. Even though I got a 1099, everybody's talking about their W-2 jobs. 1099 job is pretty much the same, because if you don't take a shower, show up, and do your job, then you don't get paid. Whether it's a 1099 or a W-2, it doesn't matter. So I had that realization, and falling back on my background with the rental business, I started buying single families, duplexes, triplexes. Liked it so much that I said, okay, well, I want to go bigger. I want to, this pursuit of this financial freedom. I realized that at the number that I wanted to get to, I was going to be mathematically eliminated before I died if I didn't somehow pick up the pace. So that's what led me to going to larger unit counts per property.
That's awesome. So can you help us understand how, over the course of how many years roughly was that? You said you worked with the appraisal company in college, and then you got up, and it sounds like your dad taught you a lot of good exposure to some of this within the real estate. And then how long were you in that brokerage business till you had that realization, hey, let me shift my focus really to move into this multifamily or these larger unit counts?
Yeah, so I had, I guess I was kind of doing both. I had a foot in both for probably 15 years. I bought a 10 unit. The largest place I had bought at the time in 2013 was a 10 unit, or was a 3-unit place. And then, so in 2013, I bought the 10 unit place. And to me, that was, that might as well have been 400 units at the time. And that was like a really big deal just to get my head around after coming from what I had experienced already. So that was in 2013. And so that's what, 12 years ago ish.
Mm-hmm.
I bought the 32 unit place in 2018, and then we've grown 37 units, and then most recently a 196 unit place, and that was 7 months ago in February. And I'll tell you what really like shocked me not out of it, but like what made the biggest change. In 2017, believe it or not, I had a heart attack, cardiac arrest, and I was dead and gone. So, after that happened, you might imagine lots of things changed for me. But one of them was this realization, because I was kind of in a state of physical and mental recovery for a couple months anyway after that happened. And literally, there was a significant period of time that I didn't answer the phone. I didn't check email. I just didn't interact. And so, when you realize all of a sudden, like, wait a minute, my family is surviving financially because of these rental properties that we own. That was when it really like hit me like, okay, yeah, you've read the books and it makes sense. But when you realize like this is a life-changing thing. This really does work. And you really can survive on it. That's, instead of being happy with what I had, that's when I really like, all right, I'm all in on this stuff. And I want to go bigger. I reevaluated my goals and set higher goals. Keeping in mind that stress management part, which became important to me after 2017 also.
That's an incredible story. And it's great to see that you've kind of mended well.
Thank you.
Especially with what you just shared of purchasing 196 units at the beginning of this year. Like, that's a huge jump in the space of 7 years from having a heart attack, not checking your emails, recognizing that what you already have in place is helping support your family. It'd be great if you could walk us through that acquisition process that you went through earlier this year.
Okay.
Like, how did you identify the property? How did you underwrite the property? Did you help limited partners invest in the property? Like, it would be really good if we could unpack what you went through.
Sure. Well, I will tell you that it has been a challenge. It's reminded me to really work on my stress management because it has been quite a journey full of learning. And keep in mind that I had like what I thought was a lot of experience in the business in general. So what happened was, we decided, again, we wanted to reach this goal. We set of a midterm goal, I guess, of 1,000 units, right? And so you say, okay, well, realistic goal, one a year, 200 units gets for 5 years, gets you to 1,000. And that was kind of our game plan. So we shifted our attention to underwriting deals that were roughly that size or larger. And, most of them, so we went under contract in this deal in July of 24. And if you remember back, the whole COVID stretch and, the prices went nuts and people were buying things and just nothing made sense. And I was underwriting things over and over and over and nothing made sense, to the point that I just thought my spreadsheet was broken. Like, there's got to be something wrong with my math. All these people are buying stuff and I can't find anything that works at all, even close. So finally we found this one that it worked. And I was like, oh, this is interesting. So we kept, one step at a time. We kept underwriting it. We kept pursuing it, and it kept working. And so we wrote a letter of intent. We entered the negotiation process. It was multiple offers. We made it to the best and final round with at least 4 other parties. And ultimately we were chosen. We had to fight the big battle of we're small, compared to our competition, and what makes the seller think that we can perform. So we had to sell them on that, if you will, like, how are we going to raise the money? What's our business plan, et cetera. So, we set out to, our structure is, it's a syndication model. We have limited partners and general partners. The limited partners own 80% of the deal, and we, the general partners, own 20% of the deal. In this deal, we don't have nothing fancy. There's no preferred returns or any of that stuff. Is just a straight up 80-20 split. And so we set out to raise what initially was $8 million. And we did not raise that much. I don't know how long this podcast is, but if you want to, we could talk for a couple hours about what happened between July of 2024 and February of 2025. But I'll let you ask the questions, and I'll go wherever you want to go on that.
Yeah, raising capital is definitely not easy, and it became much more difficult as rates started to climb after that peak of, late 2020, when deals and capital was essentially free, and they were raising ridiculous amounts of money in 21 and 22. And to your point, these assets were trading at crazy valuations and values. But now we've gotten to a time where capital has backed off a lot and it become much more challenging. And it's become much more challenging to underwrite these deals and to make them make sense and to make them pencil, not only for you and all the time that you're going to put into it and for it to be worth it, but for your investors. You want to prioritize them for a good return and the deal to be strong, and then to have the certain backstops in place. So I would be very curious to hear how that 7-month stretch, and you talked about your stress management. I'm sure that time in your life after 2017, you probably would tested your stress levels a bit at the end of 24. But yeah, be curious to see how that transpired for you guys. But ultimately, it sounds like you made the acquisition, so you got it done. So congratulations ahead of this story.
Thank you. Yeah, it was. I remember vividly my wife looking at me one day and saying, "This is harder than you thought it was going to be, isn't it?" And I said, "Yep, it sure is."
Damn right.
Yep, sure is. So the thing that was different for me in this one, the business is the same. You got to charge rent, you got to have more rent than your expenses. That's the basics. And it's the same whether it's a 200 units or 2 units. What was different for me was the specifics of the financing, raising that much capital. I had raised capital before, but only like $1.5 million, which took about 2 weeks, and it was done. And this was different. So the financing is the key to everything, whether it's lender or investors or whatever. And so we thought, okay, well, we know we've got this database we can raise a certain amount with, and then we can, we'll just find the rest with new relationships and referrals. And we set down a path to obtain a Fannie Mae multifamily loan to acquire it with, and then we were going to raise the capital for the difference. So as we go down this road for the financing and you get into it and you start to get real money on the line. We either threw hard money on the due diligence and third-party fees, inspections and appraisals and surveys and legal and all this stuff. So we're racking up bills as we go, and then we get a certain way in, and the underwriters say, well, because this property is in a certain market, and because it's a certain age, and because the tenant mix is this, blah blah blah, we're only going to loan you 60% LTV. Well, when you underwrite it at 70 or 75, that's a big problem, because 10% of 20 million is a lot of money. And so we're like, and to me that was frustrating, because number one, I didn't know it. I didn't know the loan criteria maybe as well as I should have. But I felt like our loan officers, or like the people that knew this stuff, should have said, hey, this one won't work because of these things. And unfortunately, we got into it and found that out on the back end when we were already kind of mid-process. So we had to switch to a different financing, kind of what I thought was at the last minute, turned out to be about midway through the road. So we get into that and we're like, all right, this new lender, we're going to do CMBS with some mezzanine lending, and we're going to loan you $19.5 million or whatever it was. And so I'm like, all right, with that proceeds and the capital that we've raised, we're done. Success, like we got it, and great job. So I'll never forget, I was sitting on the couch with my son Friday afternoon at like 4:45 in the afternoon on a Friday. And I get a phone call from New York City, and I recognize it to be the lender's telephone number. And I'm thinking, well, this probably isn't good. Who calls somebody at 4:45 on a Friday? So I answer the phone. They proceed to tell me that because of an underwriting mistake, they're only going to be able to fund like $17.5 million. So now we're roughly $2 million off. And guess what? This is 2 weeks prior to closing. So you can only imagine now at this point how much money we have at risk. We have other investors involved. We've got all kinds of things that we can't let go wrong. So basically we had to just scramble and find, extra investors. We had to find hard money loans. We had to do whatever we had to do in 2 weeks to scrounge up that much money. And my stress management was out the window at that point. But we got it
Roof will
done
blow
and we
off.
closed it, and it was not easy, but I'm happy that we did.
You may have to go on a podcast, Ashley, and talk about stress management in those situations, because I'm sure you've got a few things to share.
It was hard. I can share my failures. Yeah.
Yeah. I think one of the really important things that you're sharing there is that getting one of these properties under contract, going through all of these steps, the financing, the due diligence, is not easy. This isn't something that just happens overnight and everybody's out there able to do this, which is also why sellers want to know that you can ultimately close, right? Because sometimes this does take an awful long time. There's a lot of money. You mentioned there the hard money that you put down, right? So there's risk from your perspective, potentially other GPs that have invested their cash and capital towards that as well. So I think one of the things that LPs maybe don't understand is all of the steps that go into that initial period. What they see is a presentation, a set of slides that will show here's what your returns would be on this property, here's what the business plan will be. But if the operator cannot actually live up and perform to that business plan, it's almost irrelevant what the property is that they're purchasing, because the property is only as good as the operator that is managing that. So when you were going through these changes of the financing of this property, how did that adjust your presentation, the deck, the returns, if at all, that you were portraying to those investors that you already had, but also to those new investors that you brought in towards those final 2 weeks of the purchase?
Yeah, that's a great question. I think the main thing that saved us through all of this, because as you can imagine, it costs us the fees, the cost of the acquisition were higher because of kind of all these changes that we had to do, and it took longer, and et cetera, legal fees and 2 different lenders, and it was that kind of stuff. What saved us was the fact that we were very conservative on our underwriting to begin with. We bought the property because it performed at the numbers that we needed it to perform at before we purchased it. So in other words, it wasn't like, okay, if you buy this and if you upgrade classics to platinum units and spend all this money, then you can raise rents $200 a unit. That wasn't the plan. It was basically, if you take it over and you keep doing what it's doing, then it will make the returns you need to make. So that ultimately, the fact that we were conservative in the underwriting is what kept the deal alive to begin with. We still are, so we've been operating it for 7 months, and the August numbers were the best we've ever done. Our NOI was higher than it ever was on the previous ownership. And this is not to jump ahead, but I'm excited, and this is fresh information. By the way, we're refinancing this. We didn't even talk about how I ended up pulling this thing off, but I'm going to fast forward a little bit. We currently are about 5 months into refinancing to a HUD 223F multifamily loan, which is 35-year amortization, 35-year fixed interest rate. So we had to get a new appraisal for that. And we purchased it for $21,250,000 in February, and it just appraised for $25,400,000. So 25. So 20% in 7 months.
That's awesome.
Now, as my wife likes to remind me, that's future money. In other words, you can't pay your light bill with it, but it's better than it going down. And so we're pretty jazzed about that.
Oh, yeah.
So you should be. That's incredible.
Yeah. And again, it's been hard. The property is performing exactly the way we would want. But again, the hard part, and the part where I don't want to say that we failed, but didn't work out as we hoped or expected, was raising as much capital as we wanted to raise. So if you want to call it undercapitalized, then that's what you can call it. But if I had it all to do over again, I would somehow magically raise more than enough money that I needed before I needed it. And then talk about lowering your stress level. Because the only stress came from that exact thing. Where are we going to get the money to finish the deal? Because then when you throw a deadline on it, now that's when the stress picks up.
I think Chris and I can agree, as well, as we raise capital for different deals and often have deadlines. And to your point, there's a lot of other factors that go into closing this deal, and capital raising is just one of them. And, quite honestly, we had to back out of a deal earlier this year that we ended up losing after 6 months. It just fell out of contract, and there's a lot that goes into it, and it happens in this business, and you got to be transparent with the limited partners and the investors that it is a lot of work to line everything up so you can get to that closing table and ultimately sign the papers and transfer that property. But again, kudos to you. You have owned it now for, it sounds like, going on 7 months. Mm-hmm. You've raised NOI. It's performing well. Remind us again, where is this property located and what does your property management team look like? Can you talk briefly on the operations side? Because a lot of times that's another completely new component. As an LP, you just think, oh, I'll just sit back, I'll collect my rent, and I'll collect my distributions, and that'll be it. But the work really starts when you close on the property. So can you kind of dig into that for the 7 months of ownership?
Yeah, that's exactly right. We get to the finish line and like, oh, great, we're just starting. So the property is in Jacksonville, North Carolina, which is, in the big picture, that's a pretty small market. And it's a 1973 vintage property. It's a, like workforce housing type demographic. There is a military component. And again, this goes back to that Fannie Mae thing. All of these things factor in. Well, we didn't know that, nor do we know the effect that they would have. So now we know going forward. Our property manager is out of Charlotte, North Carolina. They already managed a property for us that was in North Carolina, and this property was also in their geographic area that they covered. So we asked her if she would like to manage this one, and she said yes, and we're very grateful. We work very well together. That we do have an on-site staff, and our property management firm manages that staff. We have a big spreadsheet on Google Sheets, and we meet right here. I stand right here in the same spot every Monday, and we talk for an hour and a half about our KPIs, about all the numbers, and then, any problems we're going to have or any projects we want to do. That's how we manage it. And it's been very effective. But yeah, it's huge. Like, property management is almost everything. And I've had to let properties go. I've had to fire property managers and go sleep on the floor in an air mattress that I bought at Walmart in a vacant unit to, turn a property around. I mean, you got to do what you got to do. But if you get a good property manager, that's huge for sure.
Yeah, absolutely. Again, the operational side of it is really where the deals are kind of won or lost. A great property can go downhill very, very quickly with bad property. A not so great property can succeed with really, really good property management. So it's extremely important, the operational side of it. And especially now that rates are higher, the operational side of things is much more important than it really ever has been. I do want to switch our focus somewhat from this specific property into something which is what you call a mailbox money mindset. Okay. So can you explain to the listeners what that really means and why does that matter?
Yeah, well, I think the perfect example for me, I used to, before the 2017 and the heart attack and all that, I had in my mind that, well, this mailbox money, I just want to have so that I can do whatever I want to do, call it. If I want to go play golf, then I'll just go play golf. And I didn't think, it never really registered with me that we were put on this earth to get an education, then go to work for someone else until you either die or retire, and then it's just over. Like, I can't, like, that just didn't ever sit right with me. And so I all right, well, then you got to have money. You got to financially be able to survive. And if you're not going to go clock in and work for it that way, then you got to get it somewhere else. And why not have it come in the mailbox through the tenants that are paying the rent and those kind of things. So that was initially what I set out to do. And then my perspective changed a little bit after the heart attack when I was laying there and, we were still able to pay our mortgage because of the rent that came in. So I realized, all right, well, it's not just about going to play golf whenever you want to. It's about taking care of yourself and the other people that you're responsible for. Maybe, hopefully, as we grow, about leaving a legacy for people that aren't even born yet. all these kind of things. And so that's what I kind of mean by the mailbox money. It's a special thing that real estate can do that other investments can't do, with all the tax benefits and, the leverage, borrowing money, letting somebody else run it, all these things, and to still get a check in the mail. It's pretty special.
Yeah, I think it's a common point of inflection that a lot of real estate investors have at some point in their career, often early when they got their first rental property or they invest in their first deal and they start to see distributions. Or like myself, I bought my first property in 2016 and then rented it out and started to see there's tenants paying my mortgage. I'm getting more extra money each month, paying down my bills. I'm able to pocket the rest. Right? And it becomes that inflection point where you're like, this is really something I should double down on. And it sounds like you had that similar thought. You've been exposed to this industry your whole life, but then you went through different stages, I would say, right? And then 2013, you bought that 10 unit. That's another stage you stepped into where you're like, wow, I can scale this. And then 2017 with health and really reflecting and like, let me double down. And now you probably, in 2013, when you bought a 10 unit, you probably would have never imagined buying a 197 unit.
No.
Right?
For sure.
So it's pretty cool to reflect on stuff like that and just think about partially in yourself too. You probably had these limiting beliefs of what was possible. And I think we all do, right?
100%.
Then you break through that wall and you're like, shit, now I just bought a 200 unit, right?
Yep.
And so I think that's a common theme for not only yourself, Chris and I, are the people listening to this. Like, if you put your mind to something and then you really don't listen to those limiting beliefs and try to break through that next wall, there's so much that's possible. And I think through real estate, it's a very powerful avenue to do so. And so with that said, now that you're at where you're at and you've learned so much from this last deal over the last 12 months, I can only imagine, or 18 months, where do you see your business and how do you kind of look at your business today and the portfolio you have? Where do you see that going based on kind of the market that we're in, where rates are, and then just the foreseeable future? I know we talk to people often. You don't have a crystal ball. I wish we did, but where do you see for the next 3 to 5 years where that?
Yeah, that is, as you might imagine, that very topic is on our top of our list every day right now. So really for us is, I do always have this self-aware analysis. Am I getting from this what I want? I set out to do this in the pursuit of that mailbox money and less stress and more security and all those things. So I have to balance, like, all right, Ash, don't get like, you don't need to create this huge business where you've got to do 2 deals a year just to get the management fees to pay your staff. Like, that's not what I'm in this for. Right. I'm still an investor at heart. And so I want, I see myself, even though I'm the general partner and I'm like the guy doing the hammer, the work, right? But I still see myself as an investor. So I want that return for myself. Where I see our business going, we still want to reach that 1,000 unit goal. And what we've learned in this past 12, 18, whatever months it's been, is that it's more than just the friend and family investor that we need for the $50,000 investment. And in order to do business with people that can write larger checks, they have different expectations. And so we're structuring our processes, our procedures. Our CPAs have grown with us in sophistication and, like official reviews of financial statements and, things like this, succession plans in our management, things that people would expect. Like, this is not just Ash going out and buying a place and, hey man, you guys want in on this with me? It's kind of, it's grown a little bit. It's the same idea. It's just a little bit more structured, I guess. And systematized, very transparent, because we do want to grow, but we do want to grow and be successful and take care of our investors, not just grow just for the sake of it. I personally see, as far as like the real estate, we are seeing opportunities now that we haven't seen for a long time. And, so we operate a lot like North Carolina, South Carolina. So with a few exceptions, if you looked at something like, if it gets over $100,000 a unit on a purchase price, then it's overpriced. Like, it just, again, if you're downtown Charlotte and it's a Class A and, the rents are $3,000 or $4,000 a month, that's a different story. But we're starting to see prices come now below that $100,000 a unit. That 1% rule is starting to like show itself again, where it didn't for many years. Unfortunately, I think there are probably a lot more operators than we'd like to think that are in trouble right now. We know of one that they couldn't crack their monthly financial obligation nut if they were 100% full at market rents. Like, it's just, they're upside down that much that there's nothing really they can do. So it's either a capital call or you sell it and pay the debt off and move on. And so I don't want to be in that position. And I don't wish that on anybody, but I do think there are opportunities coming for people to help others out of a tight spot and make a good investment at the same time.
I think it's a really good point, and I don't think anybody really wishes that on anybody, right? No one sets out at the start of this to turn a property upside down. No one would have predicted how fast the interest rates climbed, right? Like it's one of those scenarios that you just wouldn't really be able to have forecasted what took place. With that being said, though, from an investor standpoint, and you said that you still look at a lot of this from like an investor's point of view, what are some pieces of advice that you would give either a first-time investor or somebody who has invested on questions they should ask, or how should they spot a bad sponsor or a bad deal before it's too late? Because there's a saying that Brian and I use, which is no deal is better than a bad deal. And if it does take 6, 12, 18 months to identify a deal that we're comfortable with, like, that's okay. Because at the end of the day, no one's setting out to try and lose investors' money. No one's setting out to try and lose their own money. So what advice would you give to someone who asks you that?
I don't rephrase the question for me one more time.
Yeah. So how would you as an investor identify some red flags from an operator that you are looking to invest your funds with?
So I think one is that if it's too good to be true, it probably is. I follow this stuff on social media. Yeah, I geek out on real estate. It's the podcasts I listen to, the books I read. And so I get, the algorithm feeds me lots of this stuff. And, I see other sponsors offering these, 3 or more times your money and, like 30% IRR. I'm like, I just don't like, maybe it's true. I don't want to be a skeptic, but that seems, if it is true, then I should be investing with them and not doing any of this. Right. So just, I don't say be skeptical, be healthy skeptical. I think, you have to understand, you have to educate yourself on what do these numbers mean? How do you arrive at these numbers? And is it a realistic chance that you might get there? Nothing is for sure. And if you're not willing to lose 100% of your money, then you shouldn't invest it at all. If it's whatever it is, you should be at least prepared to say, okay, well, it's not going to kill me if I lose this. Now, that being said, I'm not doing this to lose money. I'm doing it to make money. And so I think you investigate the track record. I think you talk to people, you ask around, like, hey, Chris, I heard this Brian guy's, got a fund going. Should I get in it or not? And you learn the best you can that way. I've had several people that invested in my deals that they say, Ash, I don't even want to see that spreadsheet. Only reason I'm doing this is because of you. I trust you. I know you. And talk about, now that'll add a level of stress too. Like, oh gosh, if they're doing it just because of me, but that ultimately that's what it's about. I mean, you do business with people, like, and trust. And so as an investor, you should get to know the sponsor. You should decide, do you like them or not? And do you trust them or not? And if you can trust them to sleep on the floor of an empty unit so that you don't lose your money, then that's probably a good sign that you can proceed. If you think they're going to just walk away and leave you hanging, or you don't get a good feeling about them, then you probably shouldn't do business with them.
I think that's great advice, because at the end of the day, it comes down to, again, the operator and the people that you're investing in. The deal could be a home run deal, but with a really bad operator or an operator that's not going to manage it well, it can go south quick. And same is true as to a deal that might not be the best deal, but you have an operator in place that is going to do everything in their power to ensure occupancy levels are high, that the tenants are happy, that they're managing that at the highest level possible and doing everything they can to do so. Right? You really feel confident in that. And I think too often people look at those shiny IRR numbers or look at marketing decks and slicks that, you see every operator make. It's easy to make that stuff now, right?
Yeah.
But at the end of the day, you're investing in the people. You're investing in, this is very much a relationship business. And I think that's super important to call out. So, Ashley, you shared a ton of incredible information today, and I'm excited to hear about your journey and the growth. Where can people find you if they want to get in touch with Ash and your company and potentially invest and, get on a call with you? Where can they find you?
Yeah,
Share your
probably
website,
the easiest way is right
else.
there, that abgmultifamily.com right there. abgmultifamily.com. And then from there, you can find us on LinkedIn and Instagram and our phone number if you want to call and talk. We're when I say we, it's just me and another guy. And, we I don't say informal, but, I'd love to talk to people. I'd rather talk to somebody than type emails back and forth. So anytime I can get on the phone or a Zoom call and meet people is great for me.
I agree. And hopefully if we get down to the Carolinas, maybe we can get on the golf course together and talk shop.
Oh, I'd love to. Yeah. Anytime I can have an excuse to go play golf, I would be happy to host you.
Are we doing a Ryder Cup style?
Yeah, we need some revenge. So yeah, we'd have to go.
That wouldn't be hard. I'm not the best golfer, Ash. That definitely wouldn't be difficult.
We can bring my 9-year-old son out. He's beating me now. I mean, we have, it's handicapped a little bit, but he's definitely winning the matches. So
I'm sure he would probably beat me as well. It's not.
I'd love to get out there with you and talk shop.
Absolutely. Well, we really do appreciate you taking the time to share your story. We'll put abgmultifamily.com and some other links in the description of this so people can find you very, very quickly and easily. But again, thank you, Ashley, for your time. We really do appreciate you sharing your story. It's great to hear that you are feeling much better, managing those stress levels from 2017. And congratulations again on a fantastic deal from earlier this year.
Thank you very much, Chris. Thank you, Brian. Nice meeting you both.
You too.